2023 was the year of the catastrophic event that shook the very foundation of the banking system. A crisis of unprecedented proportions has struck the United States, leaving millions of citizens in despair and hopelessness. This year, the banking system is on the brink of collapse. The once mighty institutions that held the wealth of the nation are now teetering on the edge of oblivion. But before diving into more about that, let me first welcome you aboard for this episode of Finance Arc. On this channel, we set sail on a journey into the vast realm of financial matters, where we guide you through every step of the process and assist you in navigating the challenging world of finance, from simple budgeting advice to more advanced investing strategies. So grab your life vest and get aboard the Finance Arc. Silicon Valley Bank, once a major tech banking player and the 16th largest bank in the US, collapsed in just a day and a half, becoming the second biggest bank failure in US history. The stunning collapse sent shockwaves through the global markets, causing other bank closures and threatening the livelihoods of startups across the country. With nearly half of the country's venture capital-backed tech and life sciences companies relying on SVB, the question remains, what led to its downfall? From serving fledgling tech companies in 1983 to having millions invested by Roku, Roblox, and many others, SVB's collapse is a cautionary tale of how even the biggest players can fall. Let's find out more about this mighty bank, SVB. Silicon Valley Bank was popular with US venture capitalists and tech startups. During the pandemic, the tech sector boomed, and SVB experienced significant growth, with around 50% of US startups having deposits in the bank. In 2021, deposits surged from $61 billion to $189 billion. SVB invested $80 billion of tech deposits in long-term bonds and securities to generate profits. However, as inflation began to rise in late 2021, the risk management team at SVB ignored this risk and failed to take appropriate measures to hedge against it. This decision ultimately led to the bank being caught off guard when the US Federal Reserve raised interest rates, resulting in $15 billion of unrealized losses by the end of 2022. The higher interest rate environment made it difficult for startups to secure financing, leading to a drying up of credit. Deposits at the bank started to slow down, and every large withdrawal required SVB to sell some of its long-term bonds, further exacerbating the bank's liquidity issues. Although the bank initially had enough liquidity to handle the situation, things quickly worsened, leading to a crash for SVB with ripple effects felt by the tech industry and financial system as a whole. This situation highlights the importance of effective risk management, especially in a rapidly changing market environment. Banks and financial institutions need to be consistently vigilant about potential risks and take appropriate measures to hedge against them. This includes monitoring market conditions and adjusting risk management strategies accordingly. In a sudden turn of events, SVB's bonds were worth $17 billion less than their fair value, leading to a significant risk that ultimately caused the bank's downfall. As interest rates rose, the bank's deposits fell by almost $30 billion, with the vast majority held in a few accounts. To address the decline in deposits, SVB sold a significant amount of securities at a $1.8 billion loss. This caused investors to panic and withdraw their funds, resulting in a run on the bank and the start of SVB's collapse. The stock prices plummeted and startups were urged to withdraw their money, which turned into a tidal wave of withdrawals, leading to the bank's free fall. CEO Greg Becker had already predicted the bottoming out, but it was too late to prevent SVB's demise. as the financial world watched Silicon Valley Bank struggle to keep afloat. Concerns arose about the bank's ability to cover deposits as customers attempted to withdraw a staggering $42 billion. With the bank running out of cash, regulators stepped in and seized the bank. Although the FDIC assured customers that insured deposits would be accessible in 3 days, concerns loomed over the uninsured deposits worth over $151 billion at the end of 2022, which exceeded the $250,000 limit. The bank's collapse had a ripple effect as Signature Bank failed just 2 days later, with its own set of issues, becoming the third largest bank failure in history. The banking industry is currently facing a whack-a-mole situation, with federal and state officials trying to maintain confidence in the industry to prevent a bigger panic. Even uninsured deposits over $250,000 were covered by regulators. But President Joe Biden and others are blaming the Dodd-Frank Act rollback for the bank failures, leading to investigations into SVB. SVB's focus on Silicon Valley and its reliance on the industry's short-term and fighty deposits made it vulnerable to a run on the bank. While investigations into SVB are underway, the bank's clients can expect to have their money returned, but shareholders will not be as lucky. Then, what steps does the banking industry take to prevent future failures and protect depositors without the chance of a bailout? As for the possibility of a bailout, the Treasury Secretary stated that it is not going to happen, but the focus remains on meeting the needs of depositors. The banking industry is now on high alert, with stakeholders watching closely to see what measures will be taken to prevent a reoccurrence of such events. The collapse of Silicon Valley Bank is a wake-up call for all of us. It's a reminder that we need to be vigilant in managing risk and be prepared for the consequences of a weak framework in our economy. Are you ready to take control of your finances? Subscribe to our channel for more tips on savings and investments. Don't forget to turn on notifications so you never miss a new video. Let's grow our wealth together. Stay tuned.